Without further ado, let's go ahead and get started with the webinar. That's me. I'm your presenter for today, Michigan Santa, principal of the Wolf Group. It's our standard firm disclaimer. So today's webinar is going to be a little bit different than we do on an annual basis. There are going to be different topics. In fact, if you'd asked me this time last year if I would do the annual client webinar and it would include topics related to executive orders and tariffs and trade wars and retaliation taxes, I would have been like, what are you talking about? No, probably not. But here we are. We've got a lot of moving parts that are floating around as it relates to taxes right now. So I'm going to go into the ones that, there's a lot of things happening with the U.S. government. I'm going to go into the ones specifically related to U.S. taxes and how they may impact both the 2024 tax return, perhaps the 2025 tax return, and maybe even the 2026 tax return. We're going to talk about the Tax Cuts and Jobs Act sunset, and then we're going to go into some general updates related to international cross-border taxation, non-resident alien taxation, and state tax updates. Okay, so first and foremost, let's talk about executive orders. So on January 20th, when President Trump took the oath to become president, right afterwards, there were a bunch of these black folders that were handed to him, and during the press conference, he signed a lot of the documents that were in those. Those are executive orders. There have been, since the 20th, a lot more executive orders have been issued. In fact, every morning I wake up, I go look at the executive order page under presidential actions, and I see kind of what's been put out there so that I know if there's anything that's going to affect our clients, we can then, adapt accordingly. But an executive order is basically just a directive from the president to the federal government agencies on the approach that the president wants that agency to take on certain issues, topics, or matters. The executive orders can be litigated, meaning they can be challenged in a court of law, and they can be challenged under the Administrative Procedures Act. And we'll talk about, are there any ones that pertain to this audience that have been challenged under either of those? Oh, and I just also want to make the point that some are implemented or go into effect the moment they're signed. Some have a waiting period where, they wait maybe 30 days or 60 days or whatever it is before they get implemented. So the first executive order, this one came through on January 20th, was the freeze on regulations. And so this is a very, very important one and pertains to several other topics in this presentation. But basically what it says is that all government agencies can't introduce any new final regulations for as long as this regulatory freeze is in effect. And then also any regulations introduced up, prior to January 20th may be looked at and removed or modified or changed. So just so everyone understands, in the run-up to January 20th, the IRS released a fury of final regulations. I mean, the first, I would say, 2 weeks of January, my head was spinning with just the amount of final regulations that were put out. And it was a pretty big deal. But we take all of those final regulations with a little bit of a grain of salt because they could be removed or changed or modified. And so you have to be very careful about relying on those. Also, any regulations proposed or final issued in 2024 and or 2025 may have the similar type of issues. On top of that, on January 31st, this executive order basically indicates that for any new regulation, and in the case of the IRS, we're talking about final regulations, for any new final regulation issued, there must be 10 final regulations withdrawn by the IRS. So in President Trump's first term, it was 2-to-1. So any new regulation you had to withdraw 2. Now it's 10-to-1. And that's a pretty Herculean effort to withdraw 10 regulations for every final regulation that's issued. That would take, I think, a lot of work to figure out which ones need to be removed to introduce a new one. This one, we circle back to January 20th, and this one is directly linked to EV credits, clean energy credits, solar panel improvements. So I've been telling a lot of my clients, go ahead and if you're going to do those improvements or you're going to buy an electric vehicle car, get those things done as soon as possible, because you may not get that credit in 2025 and you may not get that credit in 2026. Here's a snip, here's a snip of the House Ways and Means Committee. They've introduced kind of a talking point paper on things that they're exploring for the new tax code. And this is a snip that basically says that they're looking at potentially repealing all of the green energy tax credits that have come through over the last couple of years. And in doing so, those credits would no longer be available. So again, if you have any questions on those clean energy credits, the EV credits, the solar panel credits, please let us know. But that definitely is something that is in play. The next executive order relates to American citizenship. This one theoretically does not go into effect until, I believe, February 21st or February 16th. It's one of those dates. But it's currently under litigation, so uncertain as to when it will, go into effect, if ever. But basically, this one is a reinterpretation of the 14th Amendment, and it basically says that any child born after the date of that it goes into effect it would not be a U.S. citizen unless they are born to, unless one of the parents is a U.S. citizen or a green card holder. And then for that green card holder, they have to have a clean record, so they can't have, criminal convictions or certain things like that. So it's a very kind of narrow reading of U.S. citizenship by birth. There is a hiring freeze in effect, and that's what this one says, that no new government employees can be hired. It's gone even deeper than that now. In fact, this presentation we're talking to you on February 6th, 2025. So as of midnight tonight, so I guess 11:59 p.m. tonight, certain IRS employees have been offered a buyout, or a lot of government employees have been offered a buyout, but specifically pertaining to the IRS, there's been a lot of IRS employees that have been offered a buyout, and they have until 11:59 p.m. tonight to either take that buyout or not take that buyout. We'll talk more about that here in a minute, but due to the hiring freeze, the IRS has already terminated. There was a whole bunch of people that were supposed to start on February 8th, so just a couple of days from now, and the IRS went ahead and terminated all those people and told those people those jobs no longer exist. So all of those people, mostly a lot of law students or accounting students, maybe in their first, second, third year, that were going to take jobs at the IRS. They've been told, look, you're not going to get that job. You need to go find a job somewhere else. Maybe new graduates. That's who this is going to hit the people the hardest. But then with the buyouts, just so that everyone understands, there are about 100,000 IRS employees currently with the IRS. About 18% of those are already eligible for retirement. So a lot of people think that that 18%, so call it 18,000 people, will take the buyout, and then the workforce of the IRS would get reduced immediately. So for example, by tomorrow morning, by that 18,000 number potentially. Although my understanding is that the unions that represent the IRS employees have told them not to take the buyout and given them reasons why they shouldn't. But that's something to note, that there could be a drastic decrease in the IRS workforce moving forward. And I can tell you that the tax practitioner community has been in a lot of talks recently about how we plan to approach dealing with a very limited capacity IRS, because if the IRS staffing drops to 80,000, 60,000, 40,000, that'd be a very limited workforce. How are you going to deal with that if your client were to get a notice, or have a delayed refund, or a misprocessed tax return, or a civil penalty of $10,000? That creates a very different landscape moving forward that needs to be considered. The IRS sent a memo out to all their employees, actually just this morning, indicating that they believe that certain employees that are necessary for the tax filing season, regardless of whether they take the buyout or not, would be obligated to work until May 1st, no matter what they do. So this is maybe a point of contention that could come into play over the next couple of days. It's also important to note that the IRS really has no central leadership right now. The commissioner, Danny Werfel, resigned on I believe, January 17th. So the IRS has been without a commissioner since that point in time. There is an acting commissioner, but there's not been an actual designated leader of the Internal Revenue Service. Okay, moving on. The big topic or thing that keeps kind of happening are the tariffs, this concept of an external revenue service and tax retaliation. I remember, what was it, about 2 weeks ago, we had a temporary tariff with Colombia, and then that went away. There's an agreement made, that went away. Then we had tariffs with Canada and Mexico, and now those are on a 30-day moratorium. We've got the tariffs with additional tariffs with China that have kicked in and that are going full force, and all sorts of reports that are coming out of that. Maybe goods from China can come into the US, maybe they can't, so it's an evolving area. I'm not going to talk about what tariffs are. I think everyone kind of understands what a tariff is at this point in time. But what I do want to highlight is that in the proposal by the House Ways and Means Committee, and we'll talk about this more here in a minute with the House Ways and Means Committee, but they put out two proposals. One is the doing the codifying, so it would be codified under the Internal Revenue Code, all the tariffs on China, which would bring in about $100 billion of revenue over a 10-year period. And then also codifying unified tariffs on every foreign country that would generate about 1.9 trillion in tax savings. And if you did that, if you codified the tariffs, if maybe you codify the sovereign wealth fund, that changes the ball game for what can be done under the next tax bill, because that would literally pay for half to 1/3 of the tax bill right there. And at that point in time, just about anything can be done. If you can dream it, you can do it with the tax bill. So this is something that's never been done before. But if this is put into play, it's a big deal because it's a pay-for item that would pay for a lot of stuff in the tax bill. There are a lot of talks about the External Revenue Service. President Trump has indicated that if an External Revenue Service to collect tariffs were to come into being, it would be modeled after the Internal Revenue Service. So maybe just a little bit of love there for the IRS from President Trump. I'm not sure if that's the case or not. Right now, it appears that the Customs and Border Protection Agency are the ones that handle the tariffs. So there would be a potential new agency within the government that would deal with that. It's important to know that there is a concept of what we call tax retaliation. So what that means is that if, for example, we get into a trade war where there's tariffs going on, a foreign country could come in and say, well, look, any US company that's operating in our country, we're now going to increase their tax rate to help compensate for the tariffs, and or any US persons that have interests in our country that are maybe filing tax there, we're also going to increase their taxes as well. The United States, similarly, we have this provision. It is Internal Revenue Code 891, and it does give the president unilateral authority to increase the tax rates. It's a doubling rate on both foreign corporations operating inside the United States and then foreign citizens that have ties to the US. Generally speaking, this would only apply, though, to, an example of this would be a foreign person that, say, has a US brokerage account, and maybe they have, let's say they have, investments, and they have dividends, US source dividends, and the withholding tax rate, let's call it 30%, that's the default rate. So there could be a doubling of that withholding tax rate to, say, 60%, and so forth. So the reach of 891, which has never really been used, is limited, but it can affect a lot of different things. So keep in mind that there is such a concept as tax retaliation. Okay, TCJA sunset. So the current tax law that we operate under is the Tax Cuts and Jobs Act of 2017. As I've said in previous presentations, this is set to sunset at the end of calendar year 2025, so December 31st, 2025. This will sunset. There will be a new tax code. I have no doubt about it. There will be a new tax code in 2025, but it's going to be contentious. And the reason why it's contentious is because of the House of Representatives. There's a razor thin margin there of 218 to 215, meaning that the Republicans literally need everyone to vote along party lines to get the tax bill passed. If you have 2 or 3 people that decide that they want to buck the system for their own whatever they're lobbying for, it could create havoc. The Senate, it's a lot easier to pass the rules, so a lot of the stuff is going to fall into the House. The House released a laundry list of things that they are considering, and it goes all over the map. It goes, it swings one way and it swings the other way. I'm going to highlight a couple things that I think are relevant that people need to be aware of. So there's a deduction called the state and local tax deduction. It's an itemized deduction on Schedule A. The Tax Cuts and Jobs Act limited this deduction to $10,000 for married filing joint. So, for example, if I'm living in the District of Columbia and I'm paying the district taxes, the income taxes in DC, prior to 2018, I could deduct all of those taxes in full, being an itemized filer. But going into 2018, it was capped at $10,000. So for people living in high income tax states, you maybe felt a little bit of pain from the SALT cap. Well, the proposals for the salt cap go from doubling it to raising it to certain amounts or making it permanent to completely eliminating it altogether. So literally all over the place. But I think that this is going to be one of the highest points of contention. I think you could see some Republicans from New York or New Jersey where this is hitting their constituent base the hardest, probably saying, look, we need to have at least some kind of upgrade from what we currently have for you to get my vote for the passage of this bill. Um, Another interesting one is completely eliminating the home mortgage interest deduction. So, for example, if you eliminated the SALT cap and the home mortgage interest deduction, I think the number of people taking the standard deduction would skyrocket to almost everybody, because then you would be just left with charitable contributions, medical and dental. And we'll get into a couple slides later, you'll see here there's an auto loan interest deduction. So if you buy a car and you're paying it on a payment plan with interest, then that would become an itemized deduction as well. So it would be very limited, the itemized deductions, if they decided to eliminate the home mortgage interest deduction. There's also a cap on the home mortgage interest deduction, which would lower the level from 750 to 500,000. One of the items that President Trump campaigned on was to eliminate the tax on tips. So that's obviously in there. There's a proposal to eliminate the tax on overtime income. There's an interesting one that's called exempt Americans abroad from income tax, but this is kind of a misnomer because all it's really saying is the foreign earned income exclusion basically would be doubled. So for 2024, the exclusion amount is 126,500. For 2025, it's 130,000. So maybe under this provision, they would double it, say from 130 to 260. And that would then eliminate a lot of income from being taxed. There's a proposal in there to eliminate the US federal estate tax. This would not affect state estate tax, though. There's a proposal to lower the corporate tax rate, which is a flat rate of 21% to 15%. And then there's a proposal to take away all of the IRS funding that they got under the Inflation Reduction Act. So 20 billion has already been taken away, and this is basically saying we're going to take away the rest of what's there minus what's already been spent. There is a proposal to make bonds, state and local bonds, taxable, which already sparked a lot of bond dealers saying, "Hey, that can't happen," because we have a lot of people investing in bonds because in some cases the income is not taxable. There's non-income tax related items that are also in effect here that may come into being. So there's draft legislation. There's so much legislation being pushed out right now because everyone wants to get their 2 cents in on what should be in the bill. But this is an interesting one that you may actually see some of these touch the actual final tax legislation proposal. And in this one, it relates to the taxpayer advocate, but basically wanting to simplify FBAR and 8938 reporting, which would be very, very interesting. Expand the independence of the National Taxpayer Advocate, make it easier to get to the advocate if needed, or the appeals office, and the mailbox rule for electronic filing, which currently doesn't apply. There's a lot of commentary and a lot of people talking about scoring the new tax plan differently than the way it's been. A lot of people, both Democrats and Republicans, do not like the Congressional Budget Office, or CBO, mainly because the CBO tells them that their tax bills cost too much. And if both are complaining about it, then CBO, in my opinion, probably doing their job correctly. But there's been a lot of conversation about using alternative methods to value the tax bill. And even the top House tax writer for the Republicans has said, look, we got to be real careful about how we score this. We can't just use any willy-nilly method because it is real dollars that will be spent here. I recently did a podcast. So the Wolf Group, we now have a podcast that was launched last July. I did a podcast with Russell Sullivan, which was super interesting. We did it earlier this year where we talk about, when do we think that the new tax legislation will actually come out? What do we think will go in there? How do you think it will work? Russell used to be on the tax writing committees under, I believe, Max Baucus, and that would be the Bush tax cuts, and he still has his pulse on the tax writing committees that are in play right now. So super interesting podcast for anyone that wants to learn more about this area. Okay, moving on to the Report of Foreign Bank Accounts, otherwise known as the FBAR. We do have a couple updates here. So we have a really interesting case that was decided by jury verdict. We don't normally see that with FBAR litigation. Jury verdict on October 3rd, 2024. It's the Sadem case. Sadem was found to be willful, so unfortunate for Sadem. $500,000 of penalties here that Sadem will be on the hook for. But the instructions to the jury were super interesting because generally speaking, when you have to prove willfulness, it's either you're knowingly willful blindness or reckless. We focus on willful blindness and reckless here because that's normally how people get convicted. And for willful blindness, they added in this additional step, which is there's a high probability that there's a reporting obligation plus a deliberate action to avoid confirming, meaning you stick your head in the sand like an ostrich taxpayer and you're going to be willfully blind, right? So you think maybe there's a possibility that you have to file an FBAR and then you choose deliberately not to find out. That could be a big problem. Reckless is obviously the reasonable person standard, plus you could have confirmed. So how easy would it be to reach out to someone to confirm whether or not you had an FBAR filing obligation? So those are some new definitions for willfulness that are now floating around since the Sadem case. As a reminder, and I wanted to really highlight this is the Schedule B Part 3 for 2024. And if you look at the top there in the blue, it says you must complete this part if you A, had $1,500 of taxable interest or dividends, or B, had a foreign bank account, regardless of whether you had to file the FBAR or not, or C, you received a distribution or were a grantor of a foreign trust. So keep in mind, Schedule B has to be completed. Even if there's no interest or dividends, you still got to complete Part 3 if you had a foreign bank account, even if you file the FBAR or you don't file the FBAR. Also, there's this caution thing here, and I put that in red about filing the FBAR in the 8938. I do have a blog post on this particular part of Schedule B. I'm very critical of the really small handwriting, the placing of this on the form. I don't think anyone reads this. In fact, I would dare say 99% of clients or taxpayers don't read their tax return at all. Most of them just go to the bottom line. How much do I owe? How much am I going to get back? Again, when you're signing under penalty of perjury, whether it's an electronic filing or not, you're signing under penalty of perjury. And that signature is basically saying, I have read every single thing in my tax return. And be very careful because Schedule B Part 3, these questions, if you answer them the wrong way, they could mean willfulness. And why do we want to be careful with that? Well, because the FBAR penalties are extraordinary. So here is the latest penalty adjustment table. This applies to any FBAR penalty issued after January 17th, 2025. So in the middle there, a non-willful penalty, the base amount is $10,000, but adjusted with inflation, it is now $16,536. The willful penalty, $100,000 adjusted for inflation, is now $165,353. And then record keeping, which is really, really important. You got to keep your records for FBARs for at least 6 years. That is now the base 10,000, but adjusted for inflation, 26,262. Okay, I've seen a large uptick in FAST Act cases that have come in recently. This is I think a very, very hot area with the IRS, at least right now. Who knows what happens after midnight tonight? But to remind you, the FAST Act came into being in 2015, and it basically says that if you owe the IRS $50,000 or more, and that number is adjusted with inflation, but if you owe the IRS $50,000 or more and you haven't gotten into some form of agreement with them to pay that back, whether it's paid in full or through some kind of installment agreement, then the IRS can send a certification to the State Department. And the State Department can then put your passport, your US passport, into a denial, revocation, or limitation status. And I've had several clients that have run into this problem, have had that certification sent over, and then we've had to deal with that, to basically let them travel back to the US. I will note that there is a case, the Adams case, decided late last year, and lately, the IRS has been taken to the woodshed for not doing a lot of their decision-making the right way. They've not been following the Internal Revenue Code or following their own rules. And so a lot of taxpayers have been challenging the way that the IRS comes up with some of these notifications. Well, here Adams tried to do that, and Adams is basically saying, hey, the IRS didn't satisfy the elements of the FAST Act, so therefore I shouldn't have had my passport revoked for my seriously delinquent debt of $1.2 million. The court agreed with the IRS, and if you read through the lines on this one, it basically says that it's really easy for the IRS to satisfy the elements of 7345, and they're actually pretty good at it. So this is not an area that is going to be easily contested. And if you have this problem, it's better to maybe come at the IRS a different way than to say that they didn't do the notification or the certification correctly. This is the 2025 inflation adjustments. This is just kind of a snip from a blog post that we put out back in October of 2024. But at the very bottom of this, you'll see that adjusted for inflation, the amount of seriously delinquent tax debt is now $64,000 for 2025. Okay, the Foreign Account Tax Compliance Act. So this is, just that everyone understands, this relates to IRS Form 8938. And what happens, just for everyone's knowledge, is that foreign banks or financial institutions, if they have US taxpayers, they have to fill out a Form 8966. That's then sent to the IRS through either the Model IGA1 or IGA2 method. And then the IRS looks for an 8938 and then they match the two up, okay? A lot of foreign financial institutions or foreign banks have had a lot of problems getting information from US taxpayers. No surprise there. And the IRS basically put out notice 2024-78 to tell the financial institutions that they have until 2027 to clean up their act to get all of the accurate information before the full FATCA enforcement will occur with the financial institutions. So now the financial institutions must actively try to obtain all the stuff on the right-hand side of the slide. And they must report that to the IRS. If something is incomplete, they must report their efforts on the Form 8966. I was at an IRS conference back in August of last year where they talked about the matching. So the matching was supposed to actually occur in 2020. It was put on hold due to COVID. It is now in full steam forward. They are identifying, they gave several examples of mismatches. I'm not going to go through all these examples here. They're in the slides. Everyone will be provided a copy of the slides. But needless to say, I think some examples are worth highlighting. So on the right-hand side of the slide, example 2, if you're filing one of the international informational reports, let's just say I have a foreign trust or a foreign pension classified as a foreign trust, and I'm filing the forms 3520, 3520A. On Form 8938, I'm not disclosing that pension or that trust again in Part 6. I'm actually just going to check a box in Part 4 saying I filed the Form 3520, 3520A. That's causing a mismatch because if the IRS gets an 8966 from that foreign pension provider or from the foreign trust, they're not going to see an entry on the 8938 that links the two up. And so the thought process here is, look, you're getting a pass from reporting this on the 8938 because there's duplicative reporting exemptions. Perhaps you don't want to do just until they get this figured out. Maybe you just want to over-report. So file the 3520, file the 3528, and then also report the value of the trust or the pension in Part 6, just to make sure that there's no matching issues. These are some other examples that I put in here that everyone can take a look at. I also did a really significant deep dive where I talked about all of these examples, and there's a lot of great links in the show notes here in case anyone's interested. But I did a solo podcast where I talked about this, and you can go find that on the podcast, which is on Apple, Spotify, and our YouTube channel. Okay, this is a big one, U.S. taxation of foreign pensions. There's been an update on basically how we look at this. As a reminder, there have never been any rules passed by Congress that specifically say, here's how you tax and report a foreign pension. As such, we are then left to use a lot of different sections of the Internal Revenue Code and guidance. So this is a non-exhaustive list of all the stuff that could apply when you're talking about classifying, reporting, and taxing a foreign pension. There's a lot that goes into it. There's a lot that you have to decipher. Quickly, I just want to highlight the difference between a proposed regulation and a foreign regulation before we get into how taxation of foreign pensions has changed. So just to be clear, a proposed regulation is not the actual law. It's just the IRS's salvo on saying how they want to interpret the Internal Revenue Code. It gives the general public the opportunity to read through it and provide comments. That's your general notice in a hearing. You don't get any more American than that, at least for today. Maybe tomorrow that changes, I don't know. But the great thing about proposed regulations is you can rely upon them. You can rely upon them until the final regulations come out. When the final regulations come out, that is the law. If something has changed, then you have to then rely on whatever the final regulations say. But those are the definitive guidance. Most final regulations are prospective. They're not retroactive, but in some cases they are slightly retroactive, which we'll talk about some final regulations that came out that have a little bit of that in it. But the reason why I bring this up is because back in May of 2024, the IRS released what are called proposed foreign trust regulations. I mentioned earlier the IRS has been getting beaten up in court because they haven't been doing their administrative procedures correctly. Mainly, they haven't been filing the Administrative Procedures Act or the APA. So a lot of the guidance they've been putting out through notices or revenue procedures, they then have to put into proposed regulations, allow time for notice in the hearing for the general public, and then produce final regulations. Well, they should have done these proposed regulations back in, I believe, 1998 or 1999. They never did them. They just did a notice back in 1997 for the foreign trust rules. And so finally, they put these out. And within these, there were some updates to Rev Proc 2020-17. When this came out, we thought, oh my goodness, this is fantastic. It's going to exempt a lot of foreign pensions classified as foreign grantor trusts from reporting 3520, 3520A forms. Then we quickly realized that it was not that helpful, that it only exempted very, very few pensions, and mainly because there was a misunderstanding that the contribution limitations actually meant value threshold. And so in order to kind of clear the cobwebs there were a lot of comments, a lot of people took umbrage with this. The IRS in the proposed regulations modified Rev Proc 2020-17 to now include a value threshold. Okay, and so there's now a $600,000 value threshold. So if you have foreign pensions classified as foreign grantor trusts, and the aggregate value of all those foreign pensions in that foreign country is $600,000 or less, then you no longer need to file Forms 3520 or 3520A if you take the position under the proposed regulations. One thing to note here is that you cannot cherry pick proposed regulations. So if you take a position under proposed regs, then the entire set of proposed regs applies to your facts and circumstances. So you got to take the good with the bad. So you may get the benefit of not reporting the 3520, 3520A here, but there could be some detrimental things, which there are in those regulations that you should consider before you move forward. Also, once you rely on these regulations, you have to continue to rely on them until the final ones come out. And as I said, there's a regulation freeze. So we don't even know when the final regulations would come out. And then lastly, these proposed regulations could be undone. So under the executive order, they could come back at a later point in time and say, guess what? Too bad, so sad. You took a position and we're going to undo these proposed regulations. And now you've got a gap in your filing for the 3520, 3520A. I have a blog post that was just put on the Wolf Group website that talks about all this in great detail. So if you want to learn more, this is where it's at. It's a 3-part series. We haven't put out the other parts yet, but there will be a part where I will talk about this new concept also introduced in the proposed regs called the de minimis savings trust. And if you look at the right-hand side, this is some examples of what a de minimis savings trust is. But again, if the aggregate value of all of your de minimis savings trusts in the country are $50,000 or less, then you may not have to file the 3520, 3520A should you want to rely on and take the risk of relying on the proposed regulations. Okay, next topic, the U.S. exit tax. We've had the biggest change to the U.S. exit tax in over a decade. This is a really big deal. I'll get into that here in a minute. But first, I want to highlight that we just got the report for the number of U.S. citizens that gave up their citizenship in the fourth quarter of 2024. It was 635 people, which gives us the total amount for 2024 at 4,819. That is the largest amount of people, of U.S. citizens that have expatriated since 2016. We don't really use the 2020 number as our watershed mark because it's an aberration. A lot of those folks actually expatriated in 2019. They just weren't added to the registry until 2020. And then the COVID year is very difficult to get an appointment in the U.S. consulate. So 22, 23 also, those probably would have gone into different years had COVID not been around. But, my personal point of view is that this will continue to trend upward. I think we'll see over 5,000 U.S. citizens expatriate in 2025. The IRS wanted to make it clear that a lot of people are under the misconception, green card holders, and normally there's about 20,000 green card holders a year that give up their green card. But a lot of green card holders are under the misconception that if the green card expires for tax purposes, they no longer need to file tax returns. You have to administratively abandon your green card, and normally that's done by filing I-407 to stop the filing of U.S. tax returns. And the IRS wanted to remind people that you need to do that. You can't just let the green card expire, or you can't just take a treaty tiebreaker position and then let the green card expire. You got to do both, treaty tiebreaker and the I-407. So really, really important to complete that last administrative step. Okay, I mentioned earlier the biggest change to the exit tax in over a decade. So in 2008, the current version of the exit tax came into being. In 2009, the IRS issued Notice 2009-85. That is the only guidance ever issued on the exit tax. This Notice 2009-85 came under fire under a case called the Arrestee case, where the tax court basically said that the notice doesn't comply with the Administrative Procedures Act, and therefore the exit tax really has no teeth. So, that case was not appealed by the IRS, so it's an interesting case. But the IRS, having that case come out, basically went to work and put out the 2801 regulations, which they promised to do back in 2009. So, 16 years later, we finally have the regulations. These were put out on January 15th. They are significant with the 2801 tax. We have a 3-part blog series coming out on this, and I will also do a webinar specifically on this topic. But I can tell you that for those folks that previously have expatriated or people that are thinking about expatriating, you do need to consider these final regulations, and we will keep an eye on these regulations to see if they are removed under the regulatory freeze or they remain in place. Okay, International Amnesty Program and Penalty Abatement Update. So a lot of movement in this area. We have 2 significant cases for the Form 5471, which is used to report controlled foreign corporations or interests in foreign corporations. Basically, we have the Mukai 2 case, which this individual was issued a $10,000 penalty for 12 years, one for each year, so $120,000 penalties. And then we have the Softy case, which similar type of penalty assessment. Both of these cases, the main point illustrated on this slide is that they're challenging the ability of the IRS to assess the $10,000 penalty. They believe that the IRS does not have that authority. Rather, they have to go to the Department of Justice, and there's a whole separate procedure that has to be done to issue the $10,000 penalty. This is in line with the Farhi case. And so these cases are there's active ongoing litigation and appeals. And so we're monitoring these closely. But the moral of the story here is that if you have a delinquent or an incomplete Form 5471, you do need to factor this ongoing litigation into how you come back into compliance, because there could be multiple alternatives outside of the usual streamlined filing submission that you may want to consider. The Mukai case also, this actually just came out yesterday. They're asking the court to reconsider the fact that the penalties, the $120,000 of penalties, is actually an excessive fine and violates the 8th Amendment. So we have here another contest of an international penalty assessed under the 8th Amendment. Forms 3520 and 3520A, generally these are to report foreign grantor, foreign non-grantor, and foreign pensions classified as foreign grantor trusts, or large gifts and bequests from non-U.S. persons to U.S. persons. The IRS on October 24th announced that they will no longer assess automatic penalties. So back in 2018, the IRS put out a campaign to really ramp up penalties on these forms. And literally overnight, without telling anyone, they made the penalties an automatic assessment. So if the form was received late or deemed to be incomplete, a penalty was assessed automatically no matter what. The IRS was also notorious for not reading reasonable cause statements. They would just throw those in the trash, as I've highlighted in previous webinars. Now the IRS is saying no more automatic assessments of penalties. They will read the reasonable cause statements. And so everyone is clapping. This is going to be great news. But I believe, and there's other tax practitioners that kind of back this up, that the penalties will still occur. They'll just occur at a later point in time. So instead of occurring there right when the IRS receives it at the Ogden, Utah unit and processes it, instead what will happen is they'll read the reasonable cause statement and be like, yeah, no penalty. And then you'll have to deal with the penalty. So in my opinion, and again, I wrote a blog post on this, I will tell a lot of people, these are the considerations. Think it through before you just send it in late or with a reasonable cause statement. Personally, I don't want to go to appeals. I don't want to have to deal with an appeals officer to argue anything. I don't want to pay an attorney to do that. That's a really costly exercise. I would much rather take the extra steps of continuing to use a streamlined amnesty submission or some other method that ensures I don't get a penalty versus, gambling with being the guinea pig on what is reasonable cause for a late filed 3520, 3520A, or 3520 Part 4. Okay, listen up. This is a big one for those folks that maybe have passive income out of Canada or France. Really, really, really big news here. So I talked about this a little bit last year, but we have two cases, the Brouillard and Christensen case. Brouillard is out of Canada. Hopefully I'm not butchering that name. Anyone from Canada, let me know if you think I should be saying it differently. And then there's Christensen out of France. But both of these individuals had passive income in their respective foreign countries. They paid tax on that income in their respective foreign countries, and they weren't able to claim a foreign tax credit against the net investment income tax, which is 3.8% on items of passive income once you exceed certain thresholds. They paid the tax, and they filed in the Court of Federal Claims. And they basically said that they are allowed a foreign tax credit under the U.S. tax treaty. So the U.S. tax treaty with Canada, the U.S. tax treaty with France. And believe it or not, they both won. And they're both under appeal right now. The reason why I bring this up is because there's a 10-year statute of limitations for refund for amended returns or claims of refund relating to the foreign tax credit. So right now, if you paid, net investment income tax in Canada or France, and you also paid Canadian or French tax on that same item of income between 2014 and 2024, you may want to do what's called a protective claim of refund, because if we wait a year, you may lose out on 2014 and you want to get your claim in. A protective claim is just that. It's not an actual claim. It converts to an actual claim once the court case is decided with finality. So you have to write your protective claim a certain way. You can't just do it willy-nilly, and you certainly do not want to throw in 10 years of amended returns. There's a very special way to do a protective claim of refund in this circumstance, and I would tell anyone that is interested in this or wants to do it or thinks that this may be applicable to their situation to reach out to us at the Wolf Group, and we can take a look at it for you. I will note that the reason why a foreign tax credit is not applied to the net investment income tax, and if you look at page 2 of the 1040, the foreign tax credit comes before the net investment income tax. So even if you wanted to apply it, it's virtually impossible on the tax return. But the reason why it's not applied goes to Internal Revenue Code 27. And 27 basically says you can apply a foreign tax credit under Section 901 for Chapter 1 of this code. But the net investment income tax is not in Chapter 1. It's in Chapter 2. So that is why the general rule is that you don't get a credit for the net investment income tax. This position of using the tax treaty to get the credit is an end around that general rule. And so there's a lot of issues that flow out of that. And there's a lot of people thinking that there are other countries with similar provisions in their tax treaty that would also allow this to occur. So this time next year, I could potentially be talking about Australia or the United Kingdom or some of those other countries that may come into play. Okay, non-resident aliens. So for the G4s that are maybe on the webinar or listening to the webinar, or non-US persons altogether, there's a new Form 709 NA. So Form 709 is generally used when you're giving gifts. So if you're a US person and you make a gift in excess of the annual exclusion amount, then you may have to file the Form 709. This is for non-domiciliaries, non-residents of the US. If you make a gift in excess of the annual exclusion amount, you do have to file the Form 709 NA. It is not final yet, nor do we have any instructions. I can't tell you, looking through the 4 pages of the filing, or 6 pages, whatever it is, it's very detailed. It has a lot of tie-ins. So for example, if a non-US person were to give a US person a gift of $100,000 or more, then not only would you file the 709 for the non-US person, but you'd have to file the Form 3520 Part 4 for the US person. And there are tie-ins between those two forms on the 709 NA. So be really careful when filling out and reporting this form, because there's a lot of crossover that has to be done here. The IRS has asked for comments on the form. And I believe that those comments the timeline for that has already passed. But I will note that they do expect a lot of responses, 225,000 responses they expect on this one, which is a lot. Okay, let's go to the states, and we'll talk about some stuff happening in the states, and then we'll get back to a general IRS update, and then we'll close out and take questions. So these are not law yet; these are just proposed. But the state of Virginia has proposed a child tax credit, which would be $300 per child, and it would apply to children 13 years of age or younger. And if this is made law, it would go into effect for the 2025 Virginia tax return. Virginia has also proposed a first-time home buyer tax credit that is equal to 5% of what we call related expenses for buying a house, up to $10,000. The credit is a non-refundable credit, but you can carry it forward. So for example, let's say you got the $10,000 first-time home buyer tax credit, you would use it to offset your Virginia tax due, and then any amount unused, you would carry it forward for a period of up to 5 years, okay? And for anyone wondering what is a related expense or how do I define what is a first-time home buyer, I went ahead and found those definitions for you. They're on this slide. When you get a copy of the slides, you can look through it and you can see if that's something that you may be interested in. The state of Maryland has a lot of similarly proposed legislation. So first and foremost, Maryland has proposed to double their standard deduction for tax year 2025 moving forward. They would eliminate all itemized deductions, so no more itemized deductions in Maryland. Again, this is proposed, this is not final. They would consolidate the bottom 4 tax brackets in Maryland. And so basically anyone earning income from $0 to $150,000, their income tax rate in Maryland would be 4.7%. That's for married filing joint filers. And then the top tax rates would increase. So anyone with income greater than 500,000, your tax rate would be 6.25, and anyone with income greater than $1 million would be 6.5. Additionally, for those 2 brackets, if you have capital gains income, there'd be an additional surcharge of 1%. And lastly, there is still local taxes you got to add in there. So if you're someone in Maryland and you make over $1 million plus capital gains, you're probably looking at with the state surcharge and local taxes close to 10% total tax in Maryland, which now you're getting into the DC territory. I'm not going to talk about their proposals for corporations in Maryland, but I am going to talk about on the right-hand side of the slide, there's a proposal to eliminate the inheritance tax in Maryland, but then also to lower the Maryland estate tax exemption, meaning more people would be subject to the Maryland state estate tax. The exemption currently is $5 million. They would lower that to $2 million. And I think this would maybe spur a lot of people to potentially move from Maryland to Virginia. Virginia doesn't have a state estate tax. Okay, IRS miscellaneous updates. So tax season just started on January 27th. I will note that there are brand new IRS notices that have a bunch of QR codes, which, yeah, that's great, handy, nifty. My advice is to be very careful because there's a lot of scams going on right now. A lot of people that are sending out fake notices that look just like the new IRS notices with fake QR codes. And when you scan it, it takes you to a malicious link. I personally never scan QR codes if I can get away with it. I don't do it at restaurants. I don't do it in public places. I definitely will not do it on, this is just my 2 cents. I definitely will not do it on an IRS notice. I would tell you rather go create an IRS online account and see what the notice is telling you through that. The current IRS refund timeline is still about 3 weeks on average. That's the timeline to get back a refund. That number may change based off of current things that are happening in the Treasury Department with people taking over payment systems. So keep an eyeball on that one. Identity theft. So there's annually a series on cybersecurity for identity theft. Still a very, very big deal. Tax practitioners and tax professionals and CPA firms like the Wolf Group were still a big target of identity thieves and scammers. So I pre-apologize, but please do not send our firm or any other CPA firm an attachment or take attachments or anything like that. Everything should really be done through secure links and uploads. And please take the security and your privacy of your personal identifiable information very, very seriously. There's a lot of issues floating around with this, and there's no silver bullet to dealing with ID theft. And as you can see down here, the average processing time for an identity theft case is 675 days. That is a really, really long time to get relief for such a massive, massive topic. Okay. There are a lot of scams. There are a lot of online scams. And one thing I will highlight is that social media, please, please, please. I know a lot of people love their Facebook, their Instagram, their TikTok, but I'm asking nicely, politely, kindly, do not take tax advice from any of those places, especially if it's in a 30-second clip or a 45-second clip. There's no one size fits all tax advice, and if it sounds too good to be true, it probably is. So these are some examples of some tax scams that are floating around. There's a lot of stuff that people have to be careful with. Also, when you get a tax return or you get a tax form, not only is your personal identifiable information, something you want to safeguard, but you also want to safeguard the PTIN, which is the preparer taxpayer identification number, and the CAF number of the person that you're working with. So if you're working with a tax professional, these numbers may be on your tax forms. If a ID criminal were to get these, they can use them to scam the IRS, as you can see on the slide. Someone was able to access the CAF numbers, which is how we register ourselves with the IRS, for 20 tax practitioners and submit close to 5,000 fake tax returns to generate a $47 million refund loss before the IRS caught it and stopped it. So really, really big deal going on right now. There are a lot of $1,400 checks that are being sent out by the Treasury. So these come from the COVID stimulus. There was a bunch of money set aside to send out these checks back for tax year 2021. The statute of limitations for refund to get this money comes up on I believe it's April 15th, 2025. So the Treasury Department is under a directive, at least right now, to get all this money out. It's got to go away. It's got to get off the books. And so anyone that the Treasury believed should have received this check or this money, they've sent it to. Generally speaking, most G4s are not eligible for the stimulus payments. But now you may get the $1,400 check. You never know. Now, I can't tell you what to do here, but I can tell you that I went back and looked at my records, and there is like a method for sending the money back. Here's a snip of a document that I have on where to send it to. If anyone is interested in this, I'm happy to shoot them an email or have my staff send it on over to you. There is a change to the Form 1040 for 2024. So for individual spouses that are non-resident aliens, like say a G4 or a true non-resident, that are married filing joint with a U.S. resident spouse under a 6013G or 6013H election, you now need to check this box here in the filing status that's on the slide and enter that person's name. The IRS is trying to tie out to other areas of the tax return to make sure that the accurate amount of tax is being being paid. There are a lot of tie-ins when you're making specifically a 6013G election that I don't think a lot of people follow or are aware of. And we wrote a blog post on this. It's on our website where we walk through the big ones that people need to be aware of when they make a 6013G election. So it's one thing to make the election, to file jointly, but then you have to think about how this affects other areas of the tax return, because not all areas make a non-US person subject to tax residency rules. And so there's a little bit of nuance that everyone has to walk through. And now that this is in there, the IRS will start tying this out more, and there could be notices for improper filing or improper tax assessment. Amended tax returns. So this is a really, really interesting area. So I went to an IRS conference and I was kind of shocked to learn this, but generally for amended tax returns, the IRS will let you e-file them for the last 3 years. So right now that's 2022, 2023, 2024. So if you have an amended return for 2021, I actually just learned this as well. Too bad, so sad, you have to mail that in. But for 22, 23, 24, you can e-file those. When you're e-filing an amended return, you're not sending the electronic version of that return over like you are a current year return. You're actually just sending over a PDF copy that's manually entered into the IRS, which I was kind of shocked to learn. Like, that doesn't help, right? And it still takes 30 weeks for them to process that and put that into play. So yeah, it gets the return into their queue. It actually gets it there, so you don't have to worry about the return getting lost. So those are still big wins, but there's still a lot of risk there for things being entered in improperly or red flags being put on amended returns. Okay, foreign country update, and then I believe we're going to take some questions. I think I only see one question so far. But the United Kingdom. So back in October of 2024, and we knew this kind of going into October 2024, based off of the elections in the UK, which I think happened actually on July 4th, 2024. But you have the Labour Party that won the election. They instituted the biggest change in UK tax history. They put out their position papers on October 30th, and they've kind of put out additional guidance ever since that point. You've had over close to 11,000 millionaires leave the UK. So a massive amount of people saying, look, these tax changes are just too much to absorb. We can't be here. We're out. And they've got all these new rules. You got the new non-dom rules. You got this temporary repatriation facility, the FIG regime, all this stuff floating around. So there are a lot of changes going on in the UK, and anyone that's got US-UK cross-border tax issues, you really need to make sure that you've got your T's crossed and I's dotted for income tax, inheritance tax, and trusts. These are the three big areas that changed. And if you want to learn more about this, I did a podcast with our sister firm in the UK, Safri, with Alexandra Britton Davis, fantastic UK tax practitioner. And we basically walked through all three of these areas to get her take on what exactly changed, what you need to think about with your particular situation, and maybe next steps to take before these get implemented on, I believe, April 6th, 2025. Malaysia and Singapore. So this was just announced at the beginning of the year. Malaysia and Singapore are trying to encourage businesses and skilled workers to come into their countries. They've done a joint offering under the Johor Singapore, hopefully I said that correct, Special Economic Zone, the SEZ. But basically, if you're a qualifying corporation, you can come to Singapore or Malaysia for a period of 15 years and only pay a 5% corporate tax rate. If you're a skilled individual worker, and you have to get a visa to indicate that, you can come to Singapore, and for a period of 10 years, your individual income tax will only be, Singapore or Malaysia, will only be 15%. Spain. And I'm going to be doing a US-Spain cross-border webinar really soon. I've got my good friend Carlos Gimeno coming on. He's going to speak to us about all the tax changes going on in Spain, kind of what to think about for a US person going inbound into Spain. But on January 13th, I guess Spain doesn't like the fact that a lot of US people have been buying a lot of real property in Spain. And so anyone that buys real property in Spain that's not an EU resident, as of January 13th, 2025, will have to pay a 100% tax on that purchase. So you got to really like that house in Spain if you're a non-EU resident, or else you'll be subject to a very significant tax. And then the last thing I thought I would end on this, and then I'll take questions. This is more of just a funny thing. There's apparently a lot of unknown people, and I assume they're US people, that are floating around Greenland wearing US flags and dressed in stars and stripes, handing out dollar bills and cash to residents of Greenland. And the Greenland Tax Agency has reminded the population of Greenland that if they receive any money from these people, it is taxable income to them, and they must report and pay tax on it. So really interesting that that's happening in Greenland right now. Okay, let's take questions. I've only got one right now. And this question says, you mentioned the electrification tax credits are at risk. Are you able to comment on the status of rebate programs? So rebate programs are generally with the states, or in this case, DC. That would not be affected, or I don't think they would be affected because those are state functions. I think Maryland has used up all the money allocated to their rebate programs. I don't even think there's anything left there at all. But I believe that DC and Virginia, they would still have those programs available. So, and a lot of times with these rebate programs, you're not even reporting that on the tax return for the state. You're actually doing that as a separate request directly through the state agency. So I don't think there would be any impact there, but you never know. Once it comes out, it could change a lot of things. Okay, any other questions? Well, with that, it seems like I've done my job today. Hopefully everyone's found everything to be quite educational and you've understood it all. I will be disseminating information through the podcast and through more and more blog posts. We're going to put out a lot of content this year, so we'll make sure it comes your way. We'll make sure that you get a steady diet of it. And if you have any questions, there's my contact information on the slide there. Please reach out and let us know. We wish you all a great Thursday, and we will see you next time.